Welcome, Wall Street Alpaca here. In this video, we are going to cover a few relevant ratios for your stock picking needs. Of course, our featured company is Tandy Leather Factory. This one is mostly going to have good ratios. We're going to take a look at not everything like thorough analysis in terms of what you might do in the back office, but we're going to look at things from the point of view of we're out here, we pulled up the company, we want to know as quickly as possible the basic state and the condition of the business by the numbers. How are they doing with the money and the cash flows? And we want to check for solvency to make sure that they're not on their way to bankruptcy in every company that we look at. And then we'll move on to 2 or 3 other important ratios. So the first ratio, then, we are looking at the Tandy Leather Factory Form 10Q for the 3 months ended March 31st, 2021. Usually you want to look at the 10K, and the 10Q is, or all 4 10Qs. And the reason for that is different quarters, different seasons of the year, different businesses tend to have different amounts of sales. Like regularly, Tandy Leather Factory makes more sales in the 4th quarter than the 1st quarter. So if you try to use the sales number for 1 quarter also, so if you try to use the sales quarter for 1 quarter and compare that to something like the company's whole inventory, you're not going to get the numbers that make sense on an annual basis. And we'll talk about that a little bit too when we get to the sales number. We're going to use a ratio or 2 with the sales. So let's begin. We'll just go through. One nice thing about the ratios is you connect the different financial statements with the ratios, certain ratios, and that helps produce the insight as investors that we need to see how all this is working together for the business. Now, the first ratio, though, is right here on the balance sheet. And we want to know, first of all, how's the condition of the business right now? Are they at any risk of solvency problems where they have to go beg for money, or they have to go beg to have their lease payment reduced to their landlord? So if they have to go to the bank, we don't want that. If they have to go to the market to get more money, we don't want that. And so here's how we tell right away. We take the total assets of the business. This is called the current ratio. We take the current assets, and then we take the current liabilities of the business, and we simply divide assets by the liabilities. Oops, we found total assets. We mean to find total current assets. So that inflated our ratio a little bit. Okay, so here we have the current ratio of 3.5. This is a very good current ratio for a business that is making sales that are profitable. This means that the business is at no risk of having to go to the bank and get more loans, or it means it doesn't have to go to the market and sell any of our precious stock and dilute our ownership. It doesn't have to do that because it's taking care of itself at 3.5. Now, a lot of businesses you'll find are more close to 1.5 on the current ratio, and that's also typically a perfectly fine current ratio. When it's a real big current ratio, that just means the company is likely doing very well. And in this case, that's what we have. Now, if you have a current ratio, if it's under 1.0, that's when you have a solvency issue. It means that right now that a business with a current ratio below 1 has to go to the bank or has to go to the market. It needs more money to cover its operating expenses when the current ratio is below 1. Okay, I love how this, okay. So there we go. That's the current ratio. Boom. It's a really quick thing and it's done. If you want to dig into that current ratio a little bit, there might be a time where you need to do that. And this simply isn't one of those times, especially when the cash equivalents alone are. So I guess you could dig into it, right? Okay, what's going on more directly? How much cash do they have? And you would take the cash and you'd want to compare that to the accounts payable and accrued expenses. So in this case, we got 10,000,007 in cash, 7.8 in payables, and 4 in accrued expenses. So that's what is that? About 12 liabilities, and they have 10.7 cash. So that means there's no danger. They're making sales that are profitable. There's no danger there. But that is about the first place you would want to look. Cash and equivalents plus accounts receivable minus accounts payable and accrued expenses. All right, so there it checks out. And we're done with the balance sheet for the moment. Now the next place, since we already know they're making profitable sales, but if you didn't know that necessarily, it was a new company that you were just exploring, you would want to move on and see how are they doing for producing income. They are a real business that produces sales. All right, so we're going to take the sales. We're going to take that sales number and we're going to see if they're making money from operations. And here they are. And we're going to look at operations profit. So what's the profit on the operations for that first quarter? And we would then take that operating income number and divide it by the net sales number. And so this is a percent of 4.5%. That was their operating profit. So we know that they're making money. That's all that tells us. What's the next ratio? We would want to go and do the same thing except for net income. Or here it is, net income, right? So doing the same exact thing for net income, we can just replace this operations income number. And so here, make sure your numbers if you're copy pasting, they go in right. So the net income is also positive, and it's coming in on a net income for that first quarter of 3.4% on sales. So for every dollar of sales, they made 3.4 pennies, to break that down. We're just reviewing the quick ratios. Now the deal with Tandy here, for instance, we know that Tandy has inflated costs for the first quarter in terms of one-time costs. So their costs are going to go down substantially going forward, and that means that net income number would be higher. And assuming a steady business for next year, first quarter, we'd expect a higher net income number. So we already know we're expecting growth on that bottom line, and it's already profitable, so that's good. So here if we're looking at a new company, okay, we know the company is making profits. That's good. The next thing that you want to do is check how they're making, if they're making profits. So what we learned here on the income statement, they're making profits on an accounting basis. And this could be total, there's actually business situations where they're making a lot of profit on the income statement for a while, and it looks like it's a great business. But if you actually go and do what we're going to do next, you'd see that they're actually losing money, and that they're actually imminently going out of into bankruptcy. And this is this happens. This is what you hear about with like Enron, where they were manufacturing profits on the income statement. But if you dug a little bit deeper, you would see that they were losing cash. And that. So here's what we'll do. We'll dig deeper. Here's what we want to do now. So we found out that they're a healthy company and they're making a net income. And now we took the sales number, and we want to know how much cash they brought in on those sales. So they recorded 745,000 profit. That's this number. But did they actually bring in cash? And they recorded that they brought in 2.2 million in cash. And so what we want to look at here is Here, this is called the profit margin. And here we're going to look at cash generation. And this is just like the previous one, where we want to take that, the result that we're interested in is the cash, and we're going to divide it by the net sales. So we got 10%. The 10% cash generation ratio, that's a solid number. It's not fantastic, okay, all on its own. But if they can translate that cash creation into productive investment and into eventually into net income, that should be their net income rate, then that's good. But we do know what this did tell us is that the company is going to continue in business. They're not actually going to suddenly run into a solvency issue. We know that certainly the current ratio, being well over 1.0, means that they're solvent right now. But this tells us that if they're making money and bringing in positive cash flow every quarter, which is what this cash generation number gives us, we know that where there's not going to be a surprise there. They're going to continue to stay in business. So let's see. The next ratio we want to look at. Okay, so here we'll look at something. This is relevant for if you have two pretty similar companies, like a Kohl's and I guess Kohl's and Ross stores, or it would be more like, Marshall's. Okay, so you've got these comparable companies, and they take in inventory and they sell the inventory. So what we're going to look at here is called inventory turnover. And then we'll discuss inventory turnover a little bit. Now, this is why you want to know the annual sales. In this case, we're going to underestimate the annual sales of Tandy, just so I can demonstrate this inventory turnover number. This may or may not be an underestimate now, actually, come to think of it. So 85 million would be our expected. Now, we then would divide the sales number by the inventory. And what this is the inventory turnover. This means that they turn over their inventory on the accounting basis by 2.2 times. So if you just look at it logically, if you have $40 million worth of inventory here, 38 million, and you're making 85 million in sales, you have to buy you have to sell you're selling the whole inventory, and then you buy a whole new inventory and you sell that too. That means business is flowing through the company, cash is flowing through the company, and you want to see this. So here's where it's like a warning sign or a dangerous thing. And this is in other cases where you have a big inventory and a low sales number. And this can be important too when you're comparing businesses that are very similar. We don't really have a comparable business to Tandy, but if you're comparing Kohl's and Marshall's, then you want to know which business is more turning over more inventory. And the reason for that is because Marshall's and Kohl's, they're in the fashion business in a way. If something goes really out of fashion, they could end up with inventory that will never sell. It'll never sell for what they value it at on the balance statement, on the balance sheet. So this can be a warning flag in situations like that. If your inventory is bigger than your sales number on an annual basis, that means that your inventory is likely going to become old, and you have problems maybe with investment into inventory that goes bad. Okay, so, but turning over inventory twice a year, and that's not so bad at all for a wholesaler who the whole premise of their business is that or a big financial premise of their business is that they buy in bulk and then sell it piece by piece, right? So if your wholesaler doesn't have it, like this wholesaler, Tandy, doesn't have as high of an inventory turnover number as Kohl's or Ross or Marshall's, which probably have something like a 5-6 times turnover. But that's why you can't compare the turnover between dissimilar businesses, because they're in different businesses. Their operations are going to be different. In this case, what it does tell us about Tandy, 2.2 inventory turnover, is that they do have an opportunity to refresh their inventory and keep it good and in good shape and in quality shape. And that means that's a good sign that they're going to be able to continue to serve the customer and keep the customers happy. So inventory over 2 is good here. Let's see, another good ratio we might want to look at. Let's see what comes up here. Okay, we want to know stuff like this. So you want to dig a little bit into the potential of a business. So it's a random stock pick, and you want to know, are they even making money? Maybe they sell widgets. There's some businesses out there and they start up and they become multi-billion-dollar valuation businesses. They've got a stock, they've got the stock price, and it's like it's been on the market for 3 years after they IPO'd, and then they go out of business. How does that happen? What's going on? Well, they don't have enough profit margin in their product, is what happens to those businesses. So here's what we want to know about profit margin. We take that gross profit number and we take the net sales number, and we will now calculate what's called the gross profit margin. And this is gross profit divided by net sales. So what is the gross profit line item from the financial statement that we found here? That basically means if they buy a widget for $10 and then sell it for $10, your gross profit is 0. Can't stay in business that way. If you buy a widget for $10 and sell it for $15, your gross profit margin is $5 per widget, right? About 33%. In this case, Tandy has a pretty fabulous gross profit margin of 56%. And this means opportunity. They have customers that are happy to pay whatever the price is that they ask for their products and their product mix. And we know they're happy to pay it because they're making 21 million in sales in that first quarter. So there's customers buying the stuff and they're happy, presumably. Then they have 56% gross profit margin. What that is that means opportunity. Because if you can keep the rest of your business expenses down, that gross profit flows down to the net income. And so 56% gross profit margin, again, it's pretty solid. This is most relevant in 2 different situations. If you're comparing similar businesses, you want to know which one is clearing more gross profit and as a percent. And then the second situation is if there's a turnaround opportunity. And that's something now Tandy's not quite a turnaround. They have improved operations substantially by cutting down costs. But so especially in turnarounds or in situations where you can improve the business, that would be the second thing. So you want to see a high gross profit margin in those situations because it's a lot easier to control your own business costs, right? And keep operating expenses low or bring those back down. Cut the fat is what it's called a lot in the lingo. It's a lot easier to cut the fat inside of your business than it is to go to your supplier and ask for a lower price, or go to the customer and double the price, right? It's much more likely you're gonna have less problem if you just control your own business operating expenses. So if you have a big gross profit margin and then you're not making much profit at the end, but you can cut operating expenses, you immediately improve the business, the quality of the earnings, and improve the value of the business and how much, because it's bringing in much more profit. So that's what the gross profit margin's relevance is. It's in comparable businesses and in turnarounds or simple business improvement opportunities. And in this case, we had Tandy's going through a business improvement opportunity, if you know the story of it, which we'll continue to talk about in future videos. But one of the main things they've done, for instance, costs have been coming down because previous management was overpaying a lot of employees, and they were also very inefficient in shipping. They were shipping from a lot of different locations, and they didn't have any good deals with FedEx or whomever they use as their shipper. And we know that Tandy has, in the last year and a half, created a efficiency there by bringing in a new warehouse they built and made those shipping deals. So that's how the business improvement opportunity is playing out for Tandy. And so this big fat gross profit margin, this is a big gross profit margin for is a very good sign for us. And they earn that gross profit margin because they're good at locating inventory. Okay, that means they're doing a good job sourcing, and there's other reasons for that too. Like they buy inventory overseas, which helps keep costs down, things like that. So what do we have next? What would be a good one? I think those are the most important ones. We covered current ratio to check solvency. We covered profit margin to see like how's this business doing, and they're profitable. That's good. We took a look at cash generation on the sales number, and that came in positive. So that means that there's no secret, they're not secretly rolling downhill right in front of us. With just a big balance sheet and a good current ratio, they're not rolling downhill. They're making money. Inventory turnover, so we took a look at that, and this 2.2 number on an annualized basis, it means that they are getting a chance to refresh their inventory. Since we know they have to buy good inventory and they have to sell good quality product, we need to know that they are in fact selling and inventory is not becoming stale. And then we took a look at what's the potential of this business, because it is a mature operating business, but does it have any hidden potentials? And so we took a look at what's the gross profit on those sales, and it's a pretty whopping 56%. So that's a good percent. Just for context, like a lot of companies, like a factory, manufacturers of widgets, they operate on like a 10-20% gross profit margin. So anytime costs increase for them, if they can't pass the cost on to the customer, those businesses can go and become insolvent and go bankrupt very quickly when you have a thin gross profit margin. In this case, we have a big fat gross profit margin, and that's a good sign, as we discussed. I'm sure I might be overlooking some important ratio here, but I think we covered the main ones. Every time I open up a financial statement, because I'm looking for new stock, new investment opportunities, these are the first things that I look at. The solvency and the current ratio, the cash generation, and what's the potential through the gross profit. And then I might go learn about the story of the business if those numbers are good. And then I go learn what's going on in the business according to management. And then you have something to compare management's words to. Yeah, so that's it. That's it for this video. I'm hoping you got some value out of that. I hope my face cam wasn't in the way. I tried to make sure that I brought the information up top. And these are all very good pieces of information that will help you find a great investment opportunity. Of course, I found Tandy Leather Factory, and I'm sharing that with you. Again, I have all my money in this investment because I believe it's that good of an opportunity. And see you in the next video.